Everyone remembers the moment something felt wrong. The red numbers crawling across the screen. The anchor speaking faster than usual. The sudden shift in tone from reassurance to panic. What most people remember is the crash. What almost no one remembers is what happened quietly, off camera, while the world was distracted. Because the most important rescue of the 2008 financial crisis didn't look like a bailout. There was no emergency speech, no dramatic vote, no televised signing ceremony. It looked like paperwork. And that's exactly why it worked. Here's the first truth most people were never told. AIG was not rescued to save AIG. It was rescued because letting it fail would have detonated losses across the most powerful banks on Earth. And the mechanism used to stop that explosion wasn't democracy, transparency, or public debate. It was something far quieter, far more technical, and far more dangerous. A name. Maiden Lane. If you walk through Lower Manhattan today, Maiden Lane is easy to miss. It's narrow, ordinary, just another street near Wall Street that people pass without noticing. That anonymity wasn't accidental. Because in 2008, while the public watched banks collapse and politicians argue on television, the Federal Reserve was doing something unprecedented behind closed doors. It was creating companies. Not banks, not government agencies, private, corporate entities. Shell companies. Each designed for a single purpose: to absorb financial poison so the rest of the system wouldn't have to. This story doesn't begin with AIG. It begins months earlier with a warning shot that barely registered at the time. In March 2008, Bear Stearns collapsed. Bear Stearns wasn't a household name, but inside the financial system, it was enormous, deeply connected, heavily leveraged, and stuffed with mortgage-backed securities that were rapidly losing value. When confidence evaporated, Bear didn't slowly decline, it fell off a cliff. The Federal Reserve faced a nightmare scenario. If Bear Stearns failed outright, panic could spread through the entire financial system. Other banks could follow. Credit markets could freeze. They needed a buyer immediately. J.P. Morgan stepped in, but only on one condition. They would take Bear Stearns, but not the garbage. Not the worst assets, not the mortgage bonds no one could price, sell, or insure anymore. J.P. Morgan refused to touch them. And that's when the Federal Reserve ran into a problem of its own making. Under the Federal Reserve Act, the central bank has clear limits. It can lend to banks against solid collateral. It cannot directly buy risky assets. It cannot become a hedge fund. So the Fed found a workaround. Instead of buying the assets directly, it created a private company, a legal entity with its own balance sheet. The Fed loaned that company tens of billions of dollars, and that company bought the toxic assets. On paper, the rules were followed. In reality, the rules had been sidestepped. The company was named after the street next to the New York Federal Reserve Building, Maiden Lane. It worked. J.P. Morgan acquired a cleaned-up Bear Stearns. The toxic assets were quietly transferred elsewhere. The immediate panic subsided, and almost no one noticed what had just happened. But that moment was more important than anyone realized at the time, because it proved something crucial. The Federal Reserve had discovered a way to bypass its own legal limits without asking Congress, without public debate, and without leaving fingerprints. And 6 months later, when the real crisis arrived, that same mechanism would be deployed again.
On a scale that dwarfed everything that came before it. By September 2008, the system wasn't just unstable, it was breaking. Lehman Brothers failed, money markets froze, trust evaporated almost overnight, and then the phone calls started coming in about a company that wasn't supposed to fail, AIG. At first glance, AIG didn't look dangerous. It was an insurance company, conservative, boring, everywhere. It insured homes, cars, pensions, governments. It touched nearly every corner of the global economy. But buried inside AIG was a small division few people outside finance understood, and that division had written promises it could never keep. Promises that quietly tied AIG to the survival of Wall Street's largest banks. For years, those promises looked harmless. Housing prices kept rising. Defaults were rare. The math said catastrophe was impossible. Then the housing market collapsed. And suddenly, the largest insurance company in the world was out of cash. Not in months, in days. When mortgage bonds fell in value, the banks holding them turned to AIG and demanded proof that the insurance was real. They demanded collateral. They demanded cash. They demanded it immediately. Every day the housing market worsened, the calls intensified. Another billion, another margin call, another demand. AIG didn't have the money. And that's when the truth became unavoidable. If AIG failed, the damage wouldn't stop with one company. Losses would cascade across the global banking system. Some of the largest banks in the world were exposed, and one stood above the rest, Goldman Sachs. Goldman wasn't just another counterparty. It had insured massive amounts of mortgage debt through AIG. If AIG collapsed, those insurance contracts would become worthless overnight. Billions in losses would be unavoidable. The system couldn't absorb that shock. So on September 16, 2008, the Federal Reserve intervened, $85 billion. The headline was simple. AIG was being rescued to prevent a global collapse. The government took a massive equity stake. Officials promised oversight. Markets briefly stabilized. But beneath the surface, something far more important was happening. Because the money wasn't staying inside AIG. It was passing straight through. The bailout funds entered AIG and exited almost immediately, flowing to the banks demanding payment. The Federal Reserve quickly realized it had a problem. If this continued, it would be forced to keep pouring money into AIG just to funnel it to counterparties. The bailout would never end. And worse, it would become obvious what was really happening. A backdoor bailout. So the Fed needed a cleaner solution. It needed to stop the bleeding. And it already knew how. Because Maiden Lane already existed. By the fall of 2008, the Federal Reserve was trapped. The emergency loan to AIG had stabilized markets, briefly, but it hadn't solved the real problem. The money was bleeding out as fast as it came in. Every day, banks demanded more collateral. Every drop in housing prices triggered another call, another demand, another transfer. The bailout had become a revolving door. And the Fed understood something dangerous. If this continued, the bailout wouldn't just be expensive, it would be obvious. The public would eventually realize that AIG wasn't being saved, it was being used as a conduit, a pipe. Money in, money out, straight to Wall Street. So the Federal Reserve reached for the same tool it had tested earlier that year, the Maiden Lane structure. Only this time, it wouldn't be an experiment.
It would be a full deployment. In November 2008, while attention was focused on elections, layoffs, and collapsing portfolios, the Fed quietly created two new entities, Maiden Lane 2 and Maiden Lane 3. They sounded technical, boring, harmless. That was the point. Maiden Lane 2 was designed to clean up AIG's internal mess, the mortgage-backed security sitting inside its own lending portfolio. But Maiden Lane 3 was different. Maiden Lane 3 was the nerve center of the operation. Its purpose was very specific: to buy the toxic assets that banks held, the same assets AIG had insured. By buying those assets, the Federal Reserve could cancel the insurance contracts. The bleeding would stop. The daily margin calls would end. AIG would survive. On the surface, it looked like a solution. Underneath, it was explosive, because there was a choice to be made. In any normal financial crisis, creditors negotiate. They take haircuts, they accept losses, they compromise, because the alternative is bankruptcy, and bankruptcy usually means getting nothing. This is how capitalism enforces discipline, but this wasn't normal. The banks knew something crucial. AIG could not be allowed to fail. Its collapse would be catastrophic, not just for shareholders, but for the system itself. That gave the banks leverage, and they used it. When the Federal Reserve approached them about unwinding the contracts, it had options. It could have said, "We'll pay 60 cents on the dollar," or 70, or 80. The assets were trading at deep discounts already. Markets had priced in massive losses. Any discount would have reflected reality. Instead, the Fed made a decision that would define the entire scandal. It agreed to pay 100 cents on the dollar, full price, for assets worth far less. There would be no negotiation, no concessions, no losses imposed. Every dollar owed would be paid. Maiden Lane 3 borrowed tens of billions of dollars from the Federal Reserve. AIG contributed a smaller amount, and together they paid the banks in full. The contracts were torn up, the assets were transferred, the losses disappeared from Wall Street's books. They didn't vanish, they moved. From private balance sheets to a shell company funded by the public. This wasn't gradual, it happened fast. Billions flowed out almost instantly. Goldman Sachs, European banks, major financial institutions across the globe, all made whole. And here's the critical detail. None of this was debated publicly. There was no vote in Congress, no televised explanation, no disclosure of who was paid or how much, because technically the Federal Reserve wasn't bailing out banks, it was lending to a company it created, a company named Maiden Lane. On paper, everything looked clean. In reality, the outcome was unmistakable. The largest financial institutions in the world had been rescued, quietly, efficiently, and at full price, and the public didn't know. At the time, the official justification sounded reasonable. Federal Reserve officials argued that forcing losses on banks could trigger panic, that negotiations might signal weakness, that foreign regulators might object. They framed the decision as unavoidable, necessary. But critics immediately noticed something troubling. The people making these decisions weren't neutral observers. The Treasury Secretary at the time was a former Wall Street executive. The New York Federal Reserve was deeply intertwined with the banking system it oversaw. The largest beneficiary of the payments happened to be one of the most powerful institutions in finance, Goldman Sachs. Goldman's exposure to AIG was massive. If AIG failed, Goldman would have been forced to recognize enormous losses. Instead, it was paid in full. No haircut, no delay, no uncertainty. The insurance worked, not because the system functioned as designed, but because the government stepped in to guarantee the outcome.
This is where the story crossed a line. Because the issue wasn't just the money, it was the precedent. By paying full price, the Federal Reserve sent a signal to the entire financial system. Risk would not be punished if it was large enough. Losses would not be realized if they threatened stability. Contracts would be honored selectively. That message didn't stay contained inside Maiden Lane. It spread. And then came the second phase of the crisis, not financial, political. Because while the money was moving, another problem was emerging: secrecy. AIG, despite being rescued, was still a public company. That meant it had legal obligations to disclose material information to investors, and receiving tens of billions of dollars to pay specific counterparties, that was material. So AIG prepared a filing for the Securities and Exchange Commission. It included a schedule, a list of who got paid and how much. When lawyers at the New York Federal Reserve saw the draft, alarm bells went off. Internal communications later revealed intense concern. Names were crossed out, sections were flagged, language was softened. The message was clear: disinformation should not be public. AIG was pressured to request confidential treatment. In plain terms, a government institution instructed a public company to withhold details about the use of public funds. For months, it worked. The public knew AIG had been rescued. They knew the price tag was enormous. They did not know where the money went. That gap between what people were told and what actually happened became the most dangerous part of the entire operation. Because it wasn't just about fairness anymore. It was about trust. And once trust is broken, the fallout doesn't stay contained. It grows. And eventually, someone decided to start asking questions. For a time, the secrecy held. Markets stabilized. Headlines moved on. The emergency became history. From the outside, it looked like the worst had passed. But inside Washington, something had changed. Congress had realized that trillions of dollars were being deployed with very little oversight. Bailout programs had multiplied. Emergency powers had expanded. And no one could clearly explain where the money was going. So, lawmakers created a watchdog. Not a committee, not a task force, a prosecutor. An office with one job: follow the money. The Special Inspector General for the Troubled Asset Relief Program, SIGTARP, was given broad authority to investigate how bailout funds were used. And the person chosen to lead it wasn't a career politician or a Wall Street insider. He was a former federal prosecutor with a reputation for digging until answers surfaced. When his team began examining the AIG rescue, the story didn't add up. Why had the government paid full price? Why were negotiations absent? Why had disclosure been resisted so aggressively? And, most importantly, who had actually received the money? The answers weren't volunteered. They had to be forced. The Federal Reserve argued that revealing counterparties could destabilize markets, that transparency might cause panic, that confidentiality was necessary to protect the system. But the watchdog wasn't persuaded. He requested documents, emails, draft filings, internal communications. And slowly, the picture sharpened. What had been framed as an insurance rescue looked increasingly like something else: a transfer. Pressure mounted. Congress began asking questions publicly. Lawmakers demanded names. Media outlets started connecting dots. The gap between official statements and emerging evidence became impossible to ignore. Eventually, the dam broke. In March 2009, AIG released the list. The disclosure was brief. The impact was seismic. It revealed in black and white where the money had gone.
The largest beneficiary of the AIG bailout was not AIG. It was the banks. One name stood above all others: Goldman Sachs. Billions of dollars paid in full. No haircut, no loss, no uncertainty. European banks were next. Institutions in France, Germany, and elsewhere that had taken the same risks and now found themselves protected by American public funds. The reaction was immediate. Confusion turned to anger. The narrative that had held for months collapsed overnight. This wasn't a bailout to protect insurance policyholders. It wasn't about saving retirees or pension funds. It was about making counterparties whole. AIG had been the conduit, a pipe. Money flowed through it, not to save the company, but to prevent losses at the core of the global financial system. Goldman Sachs moved quickly to defend itself. Executives insisted the bailout wasn't necessary for them. They claimed they had hedged their exposure, that even if AIG had failed, they would have survived. On the surface, it sounded plausible. In theory, hedges reduces risk. In practice, systemic collapse changes the rules. Investigators pointed out a fundamental problem. Hedges only work if the institutions backing them can pay. In a full-blown financial meltdown, that assumption collapses. The firms providing protection are often under stress themselves. It's like insuring your house with a neighbor whose house is already on fire. The deeper the watchdog dug, the less convincing the defense became. Goldman wasn't protected from AIG's collapse. It was protected from its own exposure by government intervention. That distinction mattered because it meant the bailout hadn't simply stabilized markets. It had shielded specific institutions from losses they otherwise would have faced. And that realization ignited a political firestorm. Lawmakers demanded hearings. Executives were called to testify. The public watched as bankers explained why they had deserved to be paid in full. Trust evaporated. Protests erupted. Anger spilled into the streets. Too big to fail entered the national vocabulary, not as an abstract concept, but as a lived reality. And yet, for all the outrage, something remarkable happened. Nothing. No indictments, no criminal charges, no meaningful penalties. The contracts had been honored, the assets transferred, the damage absorbed. And the system moved on. But beneath the surface, the consequences were still unfolding. Because while the public focused on morality and fairness, something more structural had occurred. The Federal Reserve had crossed a line. Before the crisis, it was a lender of last resort, a backstop for liquidity. After Maiden Lane, it was something else, a market participant. Through its shell companies, the central bank now owned assets most people would never associate with monetary policy. Hotels, shopping malls, office buildings, thousands of suburban homes. The institution tasked with managing interest rates had become one of the largest distressed real estate holders in the country. These weren't ordinary assets. They were the worst remnants of the housing bubble. Mortgages issued without income verification, developments built on speculation, loans made under the assumption that prices could never fall. For the first 2 years, the portfolios were disasters. Values kept dropping, losses mounted, public concern grew. From the outside, it looked like the taxpayer would absorb massive losses. Then the environment changed. Interest rates were cut to zero. Liquidity flooded the system. Quantitative easing expanded the Fed's balance sheet dramatically. Officially, these actions were taken to stabilize the economy, but they had another effect. They stabilized the value of the assets inside Maiden Lane. As markets recovered, the portfolios slowly improved. Hotels reopened, malls found tenants, homeowners resumed payments with the help of modification programs. The Federal Reserve realized something important. It didn't have to sell. Unlike private institutions, it faced no margin calls, no quarterly earnings pressure, no impatient investors. It had time.
And when the assets were finally sold, they were sold into a rising market, quietly, through auctions and negotiated sales. Many buyers were hedge funds and banks. Some were the same institutions that had created the crisis. By 2012, the story took an unexpected turn. The Federal Reserve announced that the Maiden Lane loans were being repaid, with interest. The narrative flipped. What had once been framed as a controversial bailout was rebranded as a success. Officials argued that the profits proved the decisions had been right all along. But critics weren't convinced, because profit doesn't erase precedent. Winning doesn't mean the game was fair. Because profit doesn't erase precedent. Winning doesn't mean the game was fair. The Fed hadn't profited because the assets it acquired were fundamentally sound. It profited because it had the power to reshape the environment those assets lived in. That distinction matters. In a normal market, bad investments are punished, prices fall, losses are realized, capital is wiped out and reallocated to better uses. This process is painful, but it's how markets cleanse themselves. Maiden Lane interrupted that process. Instead of allowing toxic assets to clear at market prices, the Federal Reserve warehoused them. It removed them from circulation. It prevented forced selling. It insulated prices from reality. And then it changed the rules of the game. Interest rates were pushed to zero. Liquidity flooded the system. Asset prices were reflated across the board. The same institution holding the distressed assets was also setting the conditions under which their value would recover. That's not investing, that's control. By holding the assets off-market and selling them slowly into a recovery it helped engineer, the Fed ensured a favorable outcome. The profit wasn't evidence of prudence, it was evidence of power. And that power came with a hidden cost. By preventing losses from being realized in 2008 and 2009, the Federal Reserve didn't eliminate risk, it displaced it. Losses that should have been absorbed by shareholders and creditors were transferred elsewhere, quietly, indirectly, and over time. To the public balance sheet, to future policy, to market behavior itself. This is where moral hazard stops being theoretical, because once markets understand that catastrophic losses will be absorbed by the system, behavior changes, risk-taking increases, leverage grows, caution fades. Before 2008, there was still a quiet fear inside finance. Executives pushed limits, but extinction remained possible. Firms could fail, careers could end, entire institutions could disappear. Maiden Lane erased that fear. It demonstrated that when failure threatens the system will bend to prevent it. Laws will be reinterpreted, structures will be invented, transparency will be delayed, losses will be socialized. And once that lesson is learned, it cannot be unlearned. The result isn't stability, it's fragility. Because every crisis that follows must be met with larger interventions than the last. Each rescue raises expectations. Each precedent narrows future options. The system becomes dependent on support. This dynamic didn't remain confined to mortgage bonds or insurance contracts. It spread. By the time the next major shock arrived, the response was immediate.
In March 2020, as the world shut down, markets seized again. This time, it wasn't housing, it was corporate debt. Bond markets froze, liquidity vanished. Even healthy companies found themselves unable to borrow. Panic returned with startling speed. But something was different. There was no hesitation, no frantic improvisation, no legal uncertainty, no debate over authority. The tools were already built. Special purpose vehicles were announced almost instantly. The Federal Reserve would buy corporate bonds, not just distressed companies, but some of the largest, most recognizable names in the world. The central bank had become the buyer of first resort. What had once been an emergency workaround in the shadows of 2008 was now standard policy. The Maiden Lane model had gone mainstream, and almost no one questioned it. Because by then, the idea that markets should be allowed to fail had become politically unthinkable. Stability was the priority, speed was the justification,
Scale was the solution. But beneath that calm response was the same underlying problem. Risk hadn't disappeared, it had concentrated. When everyone believes the Federal Reserve will step in, the system becomes more fragile, not less. Prices stop reflecting fundamentals alone. They reflect expectations of rescue. Capital flows toward leverage, toward complexity, toward scale. And the larger the system grows, the more catastrophic failure becomes, ensuring that intervention is always justified. This is the paradox at the heart of Maiden Lane. It was designed to prevent collapse. Instead, it ensured recurrence. No senior executives went to prison. No architects of the crisis were meaningfully punished. Some were promoted. Others retired wealthy. The message was unmistakable. Failure at scale is survivable. Failure at scale is manageable. Failure at scale is someone else's problem. The street called Maiden Lane no longer houses emergency vehicles or shell companies. The paperwork has been filed, the entities dissolved, but the lesson remains embedded in the system. Markets are no longer free in the way people imagine. They are managed, backstopped, curated. And when risk threatens the core, the response is no longer a question. It's automatic. The most enduring legacy of Maiden Lane wasn't the money. It was the transformation of expectations. And once expectations change, behavior follows. Which leaves one final question. If the tools built in secrecy during 2008 are now deployed openly, what happens in the next crisis? Maiden Lane is quiet now. No sirens, no emergency meetings, no shell companies absorbing the weight of a collapsing system. It's just another narrow street in Lower Manhattan, easy to miss, easy to forget. But what happened there reshaped the modern financial world. Because Maiden Lane wasn't just a response to a crisis, it was a transformation. Before 2008, the Federal Reserve was understood, at least in theory, as a referee. It set interest rates, it managed liquidity, it stood back from markets and intervened only when the plumbing broke. After Maiden Lane, that boundary no longer existed. The Fed didn't just supply liquidity, it chose what to buy, what price to support, which losses would be absorbed and which would not. And it did so without public debate, without legislative approval, and without immediate transparency. This wasn't illegal in the narrow sense. It was something more subtle, a shift in power. Maiden Lane showed that in moments of stress, rules are flexible, but only in one direction. Contracts held by large institutions are preserved. Losses that threaten stability are deferred. Markets are protected from their own consequences. And once that reality is revealed, it changes everything. Because capitalism depends on failure. Not emotionally, structurally.
Without the possibility of loss, risk has no meaning. Prices stop signaling danger. Leverage becomes rational. Fragility builds beneath the surface. Maiden Lane didn't end capitalism. It rewired it. From a system that disciplines risk to a system that manages it. From creative destruction to curated survival. This isn't a conspiracy, it's an incentive structure. And incentives shape behavior more reliably than laws or speeches ever could. That's why the true legacy of Maiden Lane isn't found in spreadsheets or balance sheets. It's found in boardrooms, in risk models that assume intervention, in trades sized for rescue, in strategies built on the belief that collapse will be contained. Because once the Federal Reserve demonstrated it could absorb virtually any asset, mortgages, insurance contracts, corporate bonds, it became the silent partner in modern finance, not an investor by choice, but an insurer by expectation. And expectations are powerful. They don't require promises.
They don't require guarantees. They don't even require intent. They only require precedent, and Maiden Lane set one. Today, the tools born in secrecy are deployed openly. Special purpose vehicles are announced in press releases. Emergency facilities are normalized. Markets react not to fear of collapse, but to confidence of rescue. Stability has replaced accountability. Speed has replaced deliberation. And while this approach may prevent immediate catastrophe, it carries a long-term cost that is harder to see. Because each intervention makes the next one larger. Each rescue raises the stakes. Each success reinforces the belief that failure will not be allowed. Until one day, the scale of intervention required exceeds the system's capacity to absorb it. That is the risk Maiden Lane introduced. Not sudden collapse, but accumulated fragility. A system that looks stable on the surface, yet depends entirely on constant support beneath it. And when support becomes assumed, its absence becomes unthinkable. This is why the story of Maiden Lane matters. Not because it was shocking, but because it was quiet. It didn't arrive with a speech or a vote. It arrived with legal documents and balance sheets, with acronyms and footnotes. It relied on complexity as camouflage, and that made it easy to miss. Most people never noticed the street, never saw the shell companies, never heard the name. But the consequences live on. In every market rally that assumes intervention, in every risk model that prices in rescue, in every crisis response that reaches for the same tools, faster and with less hesitation than before. There will be another Maiden Lane. It may not involve mortgages, or insurance contracts, or corporate bonds. It may arrive under a different name, through a different facility, for a different asset class, but the mechanics will be familiar. Shell companies will appear, money will move, losses will be absorbed. And most people won't notice, because the most effective rescues don't look like rescues at all. They look like paperwork. And that's the final lesson of Maiden Lane. Not that the system was saved, but how.